Hello everyone, thanks for checking out my video. We finally had a significant pullback and sell-off in the stock market. Last week was a bloodbath. Tesla was down close to 13%. Apple, Amazon and Meta all declined around 6 to 7%. And lo and behold, Nvidia plunged 10% on last Friday alone. That's their worst single day decline since March 2020, erasing more than $200 billion of market cap in the process. Both the S&P 500 and tech-heavy Nasdaq clocked their 6 straight negative days, a losing streak that was not seen since October 2022. To add on, the S&P 500 has dropped around 5.6% since it reached its peak back in March this year. This is the pullback that I have been waiting and talking about. With this decline, we are just 4.4% away from entering a correction territory for the S&P 500. With the big tech earnings coming up and with the macro environment looking shaky, we are currently standing at the edge of a cliff. A further push could see us tumbling down. So do stay tuned throughout this video as I cover some of the key events and happenings. Well, it has been a while since we last saw such a sell-off in the stock market. As a result of this pullback, there were many records made. First of all, as mentioned earlier, Nvidia's 10% decline on Friday is their worst one-day decline since the COVID crash, which was 4 years ago. And just looking at last Friday, the so-called Magnificent 7 stocks had erased around $400 billion of market cap alone, and Nvidia contributed about half of it at $200 billion. And if we were to zoom out and look at the whole of last week, the Mag 7 have erased a total of $950 billion from their market cap, and Nvidia was the biggest loser of the week as it shed almost $300 billion. Just to put things in perspective, this loss by Nvidia is more than the entire market cap of its rival AMD, which is currently valued at around $237 billion. All in all, it was a very tough week for the stock market as S&P 500 posted its worst weekly performance since March 2023, and both S&P 500 and Nasdaq were on a 6-day losing streak that was not seen since October 2022. I think many would attribute the latest market pullback or sell-off to the following factors: rising geopolitical conflicts, rising oil prices and sticky inflation, tempered expectations for rate cuts, and growing number of hawkish Fed officials. Alright, for the week ahead, attention will definitely be on the big tech earnings. We have Tesla, Meta, Microsoft and Alphabet lining up. In case you're not aware, Netflix was the first mega cap company that reported their earnings last week. They beat expectations, but its share price still plummeted 9% in a single day, likely because the company gave mixed forecasts and announced that they will stop reporting subscriber numbers on a regular basis starting next year. With this, it goes to show that the market has previously priced in too much good stuff in all these mega cap earnings and growth. Any sign of weakness will see their share prices drop significantly. But of course, investors will still hope that some of these big tech companies can help to revive the current half-dead rally. That said, I would like to remind viewers that hope is not a strategy. Okay, on the economic front, the first quarter GDP will be out on Thursday, 25th April. Let's see how much the world's largest economy has grown for the first quarter of 2024. But the more important data for the week would be the Fed's preferred inflation gauge, aka the PCE index, which is scheduled to publish on Friday 26 April. If we get another hot inflation data, wow, I don't know how will the market react, man. And worse still, leading up to the PCE data, imagine we get disappointing earnings from the big tech firms. Well, all I can say is adopt a very cautious approach this week. If needed, just sit back and watch how the market moves. Let the dust settle before you enter the market, either to pick up shares or to trade. Alright, moving over to the technical analysis section. I think you probably don't need me to tell you that almost all the charts are looking bearish now, including SPY, which represents the broader market. I mean, 6 straight red days and falling below the 50 moving average. What more can you say, right? Okay, so what's next? Let's discuss the bearish thesis first. Remember, I said in a strong uptrend, usually the retracement should end around the 38.2 Fibonacci level. And obviously, SPY has breached that level. What does it mean then? It simply spells bearish. I know SPY is currently sitting at a 50% Fibonacci support level at 495, but I think if the big tech earnings disappoint, this level is unlikely to hold. I would think minimally we will be heading towards the important 61.8 Fibonacci level at around 487. But will I bank on this 487 support level to hold? I'm not sure, man, given the current weak market sentiment. But one thing I do know is that this is one critical level to watch. If this 487 breaks, it means SPY has also fallen below the 100 moving average. Not trying to scare you, but I think below 487, it will open the doors to the 470s range, or maybe even April 2022's high at around 463. Okay, but just to clarify, the odds of SPY falling from 490s to 460s this week is quite low in my opinion, unless a World War III breaks out. What I mean is that there could be some form of dead cat bounce or relief rally before it goes lower, simply because the various indicators such as the RSI, KDJ and Bollinger Band are pointing towards oversold levels. To add on, here's an interesting finding. The last time the S&P 500 index declined 6 consecutive days back in October 2022, the market rebounded on the 7th day. Again, not saying this will happen on Monday, okay? The gist is the market is very oversold and some form of relief rally can be expected. It can really just be a very small bounce, so if you have the courage, feel free to trade this technical rebound. Otherwise, just stay out of this volatile week. Anyway, if we do have a technical rebound, don't be too happy yet. We would need SPY to reclaim two important levels to revive the rally, and they are the 38.2 Fibonacci level at 502 as well as the 50 moving average at around 510. In my opinion, anything below these two levels, I would call it a dead cat bounce. It means a rebound to cool off the indicators before going lower. Let's now move over to Apple. Wow, it's quite rare to see Apple being so weak. Honestly, the chart is not looking good with several bearish signals. Let's break them down. First of all, the share price is down 11% year to date and is currently trading near its 52-week low of 162 with 5 straight red candles. That's bearish. Also, if you could recall, my last video mentioned that if Apple couldn't hold the 38.2 Fibonacci level at 176, Apple could retest the support area of 165 to 167, and Apple did that, as it currently sits exactly and precisely at 165. What didn't help is that the MACD just had a bearish cross, which means the weakness could potentially continue this week. Okay, come this week, watch this 165 level carefully. If it doesn't hold, then that's the signal that the bearish momentum is continuing. And I think, just my personal opinion, we could finally see Apple trading below 160 again. And that's a new 52-week low. In case you're not aware, the last time Apple was below 160 was in April 2023. That means you would have gained nothing or maybe even sitting on a loss if you had bought Apple shares in the last 1 year. But of course, Apple can reverse anytime. I mean, market makers may just let you think that Apple is going to flush down and then they bring it up. We saw that in October 2023 when Apple went to 165 and then bounced back up to close to 200. So what should we look out for in terms of the bullish signals? Well, obviously Apple has to hold 165 first. Then we need Apple to close above 167 to 168 area. But that's not it, because 167 to 172 is this consolidation area that Apple has been in since March this year. So if we consolidate here, just be careful, because it could be a way to cool off the oversold indicators before flushing it down. For Apple to have a reversal in trend, it needs to reclaim the 50 moving average at the very least. I mean, you can see that Apple got rejected by this moving average recently. So yep, we need to close above this level for a few days, which is around 175 to 176. That is also where the 38.2 Fibonacci level sits. Remember what I said about this level? Yep, you got that. Moving over to Tesla. Well, remember I said that once Tesla breaks below the bear flag, we could see 150's range soon. And I also shared that when 150's range is in play, the gap between 146 and 152 will act like a magnet to pull the stock price to that area. So I got the thesis correct. Tesla fell to 150's range and went to fill the gap at 146. But I was too early. I thought all this would play out 2 weeks ago, but it only happened last week. Alright, now that the gap has been filled at 146, is Tesla done rotting yet? Honestly, I don't know, and given that the earnings results and forecasts are likely to be very poor this week, Tesla bulls, including myself, have to manage our own expectations. Some may argue that the worst has been priced in given that Tesla has already declined 40% this year. But is that really so? Just to add, remember this page that I brought up last week? According to Options AI website, investors can expect a roughly 9% movement after Tesla reported its earnings. The current price of Tesla is 147, which means we can expect Tesla to hit either 133 or 160. Okay, now pay special attention to what I am going to share in terms of the potential downside. Can you see this blue dotted downtrend channel? I have been talking about how Tesla could potentially hit the bottom of this channel after it broke below the bear flag. So if Tesla disappoints big time in their earnings call, I think we will finally hit the bottom of this channel at around 137 to 140. Not just that, there is this very tiny gap below that area at around 133, which you probably can't see on the screen. And 133 sounds familiar, right? That's the level that I mentioned earlier if Tesla slides at least 9% based on historical trend. And I got to be honest with you, at 130's range, there is almost no support all the way to low 100. And from 130 to 100 level, there are 2 more gaps to be filled. They are between 122 and 124 as well as 113. Okay, what I am going to share next is not a financial advice. Let's say if you are bearish on Tesla's earnings and given the volatility nature of the stock, one can consider a 133 put option expiring 26 April, which is currently priced at around 230. But a few disclaimers. First of all, I am not making this trade. Secondly, place a stop loss in case Tesla bounces up. And thirdly, this is no way a financial advice. I am just curious how much will this contract cost after Tesla reports its earnings. Alright, spare me a minute please. For curious viewers out there, if you remember, this YouTube channel got fully monetized 2 weeks ago, and last week was my first weekly video after the full monetization of this channel, and that video has fetched me $4.20 Singapore dollars. That's equivalent to about 1 cup of bubble tea, but it's not enough to top up the post yet. Well, not too bad. At least now I am not doing all this for free anymore. My reward is 1 bubble tea per video, hopefully. Meanwhile, I would like to thank the following 2 viewers who have supported the channel by either purchasing a super thanks on YouTube or a cup of coffee via my Ko-Fi webpage. Both of your support have allowed me to buy more bubble tea and coffee. As for other viewers, if it's within your financial means, you can also consider buying me either the super thanks or coffee. If not, I will also be grateful if you could just like, comment and share my videos with your friends. They say these actions will help to grow the channel. Alright, going back to the chart, let's say Elon Musk somehow able to magically excite the investors and Tesla starts to bounce, then a potential 9% move could bring us to 160. If we ever gonna pop 9%, which is very unlikely, it wouldn't excite me yet, because Tesla is still stuck in this long-term downtrend. I think bulls should only be a little happy if Tesla can break above the 38.2 Fibonacci level at 169 and be more excited if we can reclaim the 50 moving average at around 178. Anything below these two levels, I am not convinced that it's turning bullish. If anything, it is likely a dead cat bounce. Personally, I just think there is not enough catalyst to push Tesla towards 200 in the near term. Tesla's share price will likely remain suppressed this period. The charge towards 200 will only happen if Tesla's deliveries are back on track, their FSD, robotaxi, energy, supercharger network and whatnot start to print good revenue. Wall Street needs numbers and figures to justify their expensive valuation. Otherwise, it's difficult for analysts to quantify any of these future possibilities. To them, it is just a car company. The rest are just fluff until proven otherwise. So yep, that's my very honest opinion as a Tesla bull. Let's now move over to Google. Remember last week I mentioned about this bearish gravestone doji candle, and I also shared on how to look for confirmation. Well, the bearish momentum was confirmed with that big fat red candle last Monday, and Google fell for that week. That said, it actually held up quite well as compared to the other magnificent 6 stocks. Alright, so what to watch out for this week? Can you see that green dotted channel line? Remember we talked about how Google was hugging this line previously? Yes, we are back here again. So for this week, very simple. If Google continues to stay below this line, just ignore that 23.6 Fibonacci level. I don't think it will hold if the bearish momentum continues. Shift your attention to the 38.2 Fibonacci level instead, which is at 149. If that breaks, it means the bullish uptrend could be reversing. From there, I would expect Google to flush further down to the gap area between 143 to 146. That is where the 50 moving average sits. At this area, expect a bit of tug of war between the bulls and the bears. Ultimately, if we ever fall below the important 61.8 Fibonacci level at 142, it is very bearish. But that is also when I think I will buy some shares when there are blood on the street. That's a potential first entry point, at least for me. The second entry point for me is when Google continues to pull back to the 200 moving average at 137. That's a moving average that has proven to be a very strong support level because Google has only briefly fallen below it one time in the last 12 months. In terms of the upside, pretty straightforward. We need some positive catalyst from its earnings call to push Google back above the green channel line. If we can go back into the uptrend channel, then I really think we can welcome the next all-time high in the 160s range. Alright, let's now move over to the options trading section. Ladies and gentlemen, I have gotten an early assignment. I repeat, one of my contracts got assigned early, and it's none other than this cash secure put on Tesla, with a strike price of $200, which was supposed to expire this Friday 26 April. The contract was assigned to me on 18 April Thursday, which means I had to buy 100 shares of Tesla at $200 per share, and that's 20,000 US dollars. To be honest with you, I was planning to roll this contract this week, but unfortunately the assignment came early. So here are some takeaways to share with the viewers. First and foremost, always have cash on standby when you sell cash secured put. This is one perfect example. I mean, there is a reason why the strategy is named this way, cash secured. You basically need to have cash to secure the shares if they are assigned to you. And of course, this strategy should be used on a company stock that you do not mind holding on to, because we are talking about 100 shares for each contract. So, am I okay to hold 100 more Tesla shares at $200? Well, I wouldn't mind, but again, to be very honest with you, if given a choice, I would roll this contract. But don't get me wrong, it's not so much of I don't believe in Tesla's fundamentals anymore. It's more for cash flow purpose. I want to have more cash on standby to sell more cash secured puts, and also to pick up some other shares that are underweight in my portfolio, especially when the market is pulling back right now. Okay, the second takeaway for this trade is to be wary of early assignment. However, I would also like to share that early assignment is actually quite rare. For example, I have only experienced about 3 to 4 times out of close to 100 trades, so that's like less than 5%. And here are some tips to reduce that percentage and avoid early assignment. First of all, pay special attention to the time value or extrinsic value of the contract. Secondly, watch if the contract goes in the money. The deeper it gets in the money and the lesser the extrinsic value, or worse, when extrinsic value falls to zero, the chance of early assignment is very high. To add on, early assignment usually takes place nearer to the expiration date. I would say the last 5 days is the most dangerous. Let me show you an example. For long-term viewers of this channel, you would probably know that I currently have this covered call contract on Google with a strike price of $130, expiring 19 July 2024. Look at where Google is right now, above 150. Hence, the contract is very deep in the money. Check out the extrinsic value or time value too. It's so little as compared to the intrinsic value. But so far, this contract hasn't been assigned. I would say the reason is because even though the time value is not a lot, it still does not make sense for the trader to give up on the time value, aka the profits. That's another calculation and logic behind this, but I will not complicate things here. Another reason is because the expiration date is still very far away, which is actually tied to the time value. So to summarize, or the too long didn't read version, is that when a contract is very deep in the money with no time value left, the chance of early assignment is high, which was the case for my Tesla cash secured put. And oh, the last takeaway of this trade is, do not follow my trades blindly, because in the event of an early assignment like this, you may not have enough cash to take assignment. Also, if I had wrote the contract last week, you wouldn't have known until my video is out on the weekend. This is why a lot of times, if the trades that I share in my videos are new ones, I will blur out the premiums so that viewers do not follow me blindly. Anyway, my plan for this additional Tesla shares is to wait for an opportunity to sell covered call to complete the options wheel strategy. Just to also share, I have wrote this contract twice previously, and here are the calculations. As you can see, the net profit for this entire option trade is $425, which means the cost price of my new Tesla shares is $195.75 per share. Okay, if you don't know what I have been talking about for the last few minutes, do consider checking out my videos on the basics of options trading. I have a playlist with 3 to 4 videos on that. The next trade to update is this covered call on Bank of America that expired last Friday, 19 April. The strike price was $38 and the contract was sold on 5th March 2024. This trade was kind of a sure win trade. I have explained this previously. Reason is because I was assigned with 100 Bank of America shares at a strike price of $38 some time ago. So if these 100 shares get caught away at the same price of $38 per share, I have nothing to lose per se. Okay, maybe I will lose out on any potential upside. But one thing that I will definitely win or gain is the premium of $53 that I received when I sold the covered call contract. This is why I term this as a sure win trade. Anyway, since Bank of America closed below $38 on the expiration date, the contract expired worthless and I got to keep the full premium without having to close my position. For more information on this trade, please check out the video link at the top. Alright, so since my covered call expired on Friday, I decided to sell another covered call on Bank of America on the very same day, 19 April. Once again, I went with the same strike price, but this time round it paid me a higher premium of $80 as compared to the earlier trade of $53. The expiration date for this contract is 31st May 2024. So come expiration date, if the share price doesn't go above $38, the contract will expire worthless and I will get to keep the full premium without having to do anything again. Actually, I could have waited till this week to open a new covered call trade because Bank of America is looking quite bullish now. But with the ongoing wars and the weak macro environment, I decided to just go ahead to sell that call contract last week. Anyway, $38 is the level that Bank of America has difficulty breaking above. The last time round it closed above this level was back in April 2022. Yes, that's a good 2 years ago. But if let's say Bank of America is very bullish and manages to close above $38 on the expiration date, so be it then. I mean, as shared earlier, since I have gotten these shares at the same price, I practically have nothing to lose except for the upside, and I still get to keep the premium. So again, this is yet another sure win trade. Alright, as mentioned at the start of this video, the focus for this week will be on the big tech earnings. Their earnings could provide a positive catalyst and revive the market rally. But as investors saw last week, specifically on Netflix, they could also trigger a fresh wave of sell-off. Honestly, I think the big tech firms have to over-deliver and overperform to prevent their share price from falling because of the various uncertainties in the current market, such as rising geopolitical tensions and the increasingly pessimistic narrative of higher interest rates for longer. In fact, it appears to me that this higher interest rate environment is the new normal, and companies have to adapt to it. Therefore, in the interim, I wouldn't be surprised if the big tech companies continue to lose their footing this week. And oh, remember in my last video I talked about AI exhaustion, and I fleshed out the charts of Nvidia, Supermicro Computer, Meta, etc. Well, seems like things are playing out as per what I have shared, as Nvidia slipped 10% last Friday, Supermicro Computer plunged more than 23% on the very same day, and Meta dropped about 6% last week. Basically, AI-related companies are facing lots of downward pressure now. It seems like the market is doing its forward-looking thing again. Previously, the market was forward-looking by pricing in all the AI growth and demand, and now with the uncertainties in both companies' growth and macro environment, the stock market is forward-looking by taking risk and profits off the table ahead of the earnings season. Meanwhile, don't you think it's quite amazing that about a month ago, nothing seems to be going wrong for the bulls, but right now it seems like everything that could go wrong is going wrong. Things can change really fast, huh? I mean, it seems like yesterday that we were all talking about how SPX has finally broken above the milestone 5,000 mark after eyeing it for weeks. But with a blink of an eye, the index is back under the 5,000 mark again. And this happened in just 1 week. I guess like what they always say, the stock market takes the stairs up, but the elevator down. When the market wants to flush, it can flush down quickly. To add on, VIX, which is the gauge for fear in the market, has spiked to its highest level since October last year. At the same time, various indicators are suggesting that the market is significantly oversold. Interestingly, all this were completely opposite a month ago, where we all talked about the rally was very overextended and the market was getting greedy, etc. Anyway, as shared earlier, maybe it's not the time to pick up any shares this week until the dust has settled a little bit. Use this week or perhaps even next week to build your watch list, set some target prices, and then pick up some shares if the sell-off continues. Even if the sell-off doesn't go on, you can still enter when there are signs of reversal in the market and then ride the next wave up. Okay, that's all for this video. It's gonna be an eventful and volatile week ahead. Let's see how the week pans out, and we will discuss more again in the next video. Meanwhile, remember to tap the like and subscribe buttons if you haven't. Thank you.